Trin Nugent, senior economist covering emerging Asia at Natix, is joining in this afternoon on the show. Trin, great to speak with you again. Unfortunately, at a tough time, not just for Indian markets, but for the world. Why is India seeming worse off in its equity reaction compared to even markets of nations who are involved in the war right now? Is
well,
India
first,
more vulnerable? Sorry, yeah.
Well, I think India is coming from a strong position in that it's already had a lot of sell-off, and the rupee already sold off quite a lot versus the other countries who are much more exposed via the oil and gas channel in terms of share of GDP, like South Korea, Thailand, Taiwan, and so on and so forth. And moreover, they have quite rather lofty valuations because of this exuberance over AI. And so we're having here a hit, not just from an oil higher and gas higher trade, but what that means in terms of impact on food. What does that mean in terms of impact on, for example, global demand for semiconductor? You know, Taiwan and South Korea, for example, are very dependent on natural gas, and that has a feed through. So here in this global risk-off environment, you see much more of a deeper knee-jerk reaction versus India, where, of course, is quite negatively affected by it. But given that where it is today, it's not so there's not a room to sell, so to speak. So it's much more resilient. India is also, if you think about beyond the oil, gas and fertilizer impact, it's a much more inward-looking economy if you look at trade as a share of GDP. And foreign investors have been selling India rather than buying India. So for other markets, there's a lot more selling to do. And given that it's a much more inward-looking market, when you think about the stagflationary environment in which we're not looking at terms of trade shock via imports blowing up in terms of cost, but also potentially volume declining, demand destruction, then that impact on India will be much less.
Sure, Trin, just a second. I think a bit of crossed wires there. My question was, why is India doing worse off? Are you making the case that India is better off than others?
Well, I am saying that everyone is worse off, right? It's a relative game of how bad things can get for you. This is a negative shock across Asia, right? Look at imports of oil as a share of GDP. Everyone is negative. Now, even net energy exporter like Australia, which export coal and natural gas, they're down on oil. So they import refined oil, right? So this is a negative shock across Asia. It's a question of how deep is the shock? How deep is the shock to your economy? And beyond the direct cost of the economy, but also there's a risk-off financial channel where investors are reconsidering their risk appetite. And so you can have much more violence in equity markets and other markets just because there's a lot more room to sell. It doesn't mean that India itself is resilient and not affected. It's just relatively less affected. India, as you know, is affected via higher import costs. It's affected via fertilizer. It's affected via food prices eventually rising. It's affected via remittances. And of course, finally, capital flows. But the capital flow channel, in my opinion, is not as severe, and this is where my point earlier was, is that capital flows in Q4, for example, for India, were just pretty much outward. And so now we're looking at Q1 where, of course, foreign investors are risk averse, but there's a lot more selling to do in other markets.
Sure. Yeah. That's a strong point to make. Having said that, Trin, and good afternoon to you. The question that I have for you is that from an economy standpoint, you've talked about the vulnerabilities. I'm just wondering whether there's a policy response here and that you think is possible in the near term, because nobody at this point knows how long this conflict is going to last. We only have history as a benchmark, and that's not much of a benchmark at this stage. So therefore, in the interim, what according to you are the right policy measures to make?
Well, the short-term response, everyone in Asia is a scramble for energy, particularly gas, right? Because as you know, there's more storage of reserves of oil because it's much easier to store than natural gas. So everyone is very short gas. If you look at storage across Asia, the highest is Japan, where it's almost a year. And for oil, India is not doing so badly. But natural gas is where people are scrambling. So people are paying huge premiums to divert to Asia. Now that's a bigger cost, but still, since we're short, we're going to try to scramble for that. The second response is a lot of countries are now leaning towards protectionism, right? So China and Thailand already announced that they don't want to export refined diesel and gasoline, right? And Vietnam, I think, is going to be next. And I think a lot of countries are going to try to hoard as much as they can. And finally, it's the release of reserves. Releasing reserves means obviously this is your buffer for rainy days. Given the fact that we don't know how long this disruption will happen, because earlier we have G7 announcements that they'll release reserves, and that really helped the oil market because there's some temporary relief of supply coming through. So for India, it can do that. And obviously much of the reserves are in the private sector rather than the government. But the reality is that that is probably the final part of it. And finally, given the fact that this is a supply side shock, what you can do is you can try to substitute, of course, into coal. If you have renewable, you can expand that. But we're coming to this in Asia, particularly India and Southeast Asia, with much hotter months. So we have higher demand expected. Supply shock. You don't know how long the supply shock will be. So basically, first policy response is to stabilize the market, whether or not it's financial markets via stabilization of the rupee, stabilization of financial markets like Korea, where it's quite volatile, stabilization of supply, getting as much of supply as we can. If you have reserves, you can buy time, and hopefully this crisis will be over by then. But finally, I think the last resort that all governments don't really want to do is really hiking rates in a stagflationary environment, because you're not hiking and tightening financial conditions because demand is so strong and you have an economy running too hot, but because of supply, which means that you're going to crush demand, which is already essentially crushed by higher oil prices and lower profit margins anyway. So I do think that governments and central banks are saving their bullets and to watch and see. We're really day 10 of the crisis. Past day 14, I think the real worry will begin. But at some point, we'll have demand destruction and the market itself will stabilize.
If Trin Eugen thinks the real worry has not already begun, I really shudder to see what's going to happen on day 14. Trin, one word being bandied around a lot right now, in the scenario that oil prices get even steeper, is the term demand destruction. Explain to us from an economist's perspective, what does demand destruction mean, and is India more or less vulnerable to that kind of a situation?
So every part of the economy is touched by oil, either directly or indirectly. When you import oil, directly is your import cost, which then you sell as transportation. When transportation gets too expensive, you travel less. When jet fuels get too expensive, which is a huge input cost for airlines, they raise prices. When they raise prices, people travel less, right? So that's demand destruction. You get to the point where prices get so high, people stop traveling. You can see that in the yen. The yen weakens so much, Japanese people are just staying home. So that's a demand destruction. And I think here is that then what that means is that we have a supply shock. It's very difficult in the short term to find alternative supply. Of course, releasing reserves and so on and so forth is one way to do it. Shuffling between coal and oil and gas is one way to do it. Trying to expand whatever output you can. But the reality is very hard to make up for that. So the only way to meet the equilibrium is really to have demand destruction. And that's what we saw in the Ukraine war, where with Europe, with higher gas and so on and so forth, has led people to have different policy responses to limit the consumption of energy, and therefore you gradually reduce the demand of it. So the volume of it falls, and therefore oil price will peak, right? I think, it will peak and then eventually it will fall as the demand itself falls. And that's a negative scenario, right? Because you're looking at a situation where sectors like not just aviation, very obvious sectors like chemicals or fertilizer, anything that's like very, very, very heavily dependent on oil and gas.
Yeah.
But even, derivative of that, right? Like tourism sector, if you're very dependent on long hauls as a hotel or as a business, then you should look at probably demand destruction, particularly if it's routed through the Middle East, right? A country like Thailand that's heavily dependent on tourism is going to look at this very worryingly if the crisis and jet fuels continue to be a problem.
Absolutely. Trin, I couldn't have put it better. Thanks so much for taking the time. Thanks for speaking to us, and hopefully this situation resolves itself very, very quickly.
Thank you for having us.